Hello everyone, Joe Mass here. Thanks for taking the time today to go through our 2020 market review. So what a year we had, right? We're going to recap today by talking about a little bit of investment review. We're going to talk about the past, the present, and the future. We'll try to keep it as short as possible, but there's a lot to say, so we hope you enjoy it. As always, if you have any questions, please give us a call. Oh, there's my smiling face. I'm real smiley. We made it through 2020. What a year. Hey, I'll take it again. We ended up okay with our returns. So other than the emotional roller coaster, 2020 was not a bad year for the markets, as we'll see. So, one thing when we're building portfolios, I'm always trying to build portfolios that are going to capture the upside return, right? Ride those bulls and minimize the downside capture, tame the bears. And in doing that, we're trying to build better portfolios that are reasonable portfolios. They have reasonable expectations for return and reasonable expectations for risk over reasonable time periods, okay? And so that's really important to remember, because our goal is not just to beat the S&P 500 or always earn a high return. It is to earn a reasonable return based on your facts and circumstances of each individual investor. In 2020, we introduced some new portfolios. We introduced a real estate portfolio early last year. We have been building a lot of custom structured notes, and we also came out with a portfolio that's called the Beach Portfolio. The Beach Portfolio stands for Bookings, Entertainment, Airlines, Cruises, Hotels, and Casinos. And these are the stocks that are really going to be part of the recovery of the economy as the vaccines come out. So early on in the year, we had the stay-at-home stocks, right? A lot of the growth tech stocks, and the beach stocks are kind of the opposite of that. So we have a new portfolio for you to take advantage of there. We also have a focus metals portfolio in the cycle of the commodities and where we're at with the geopolitical risk. A lot of people have been asking for golds and metals and protection, so that's a new portfolio that we brought out. For people that were looking for a little more tax efficiency, because we do like to trade quarterly to keep up with the markets, but that does cause higher taxes, we came out with a focused blend portfolio. And we also have coming out in 2021 a new energy fund. In the top right-hand corner here, you can see the portfolios. So our conservative sailboats, which are our asset allocation models, you can see did quite well last year. Our focused growth, again, was a stellar year at 28%. The dividend portfolio was down, as our only portfolio that was that and the real estate that were down for the year. And that's mainly because of the sectors that they live in. Okay, so as the dividends go, they were down, but the whole value space was down. So we're right in the middle of the pack there. So again, the portfolios have held up well. Here you'll see that this is our Rowan Street Fund. This is one of our private hedge funds. It netted 48% to investors last year, so it did very well. If you're an accredited investor, we highly encourage that you ask us about that, and we can have a conversation. Okay, investing review. Since 1953, the market's pretty much gone up. But what we've seen, I've been doing this for 30 years, is that most people are not willing to take risk, right? They remember 2002, 2008, fourth quarter 2018, and they're not willing to take risk. And we find this in what's called prospect theory. Prospect theory says that people are willing to take more risk not to lose money than they're willing to take risk to make money. And so we're trying to re-educate people that if we want to make money, we have to have a good exposure to equities. If we want to protect money, then we can follow more of an asset allocation approach, which is a very sound policy, but you're not going to have equity-like returns, okay? So the reason that people are adverse to risk is because of these blue, yellow, and red bars. The blue bars represent a 5% drawdown in the market over a 30-day period. The yellow bars represent a 10% drawdown over a 30-day period, and the red bars represent a 20% drawdown over a 30-day period. And you can see down here at the bottom of the chart that we added another day last year, a couple periods there where we had those drawdowns during the COVID, okay? So now the reason that we're not as concerned with these blue and yellow bars is because the time to recover and break even isn't very long. As you can see from this chart, if you're down 50%, you have to gain 100% to break even. If the market can do 7%, that's going to take you 10 years to break even. But at 5%, okay, if you're down 5, you only need to go up 5.26% to break even, which at 7% will take you less than a year. It'll take you less than a year and a half, or about a year and a half, to break even if you're down 10%. So again, because of those short break even periods, okay, we're not as fearful of those blue and yellow bars. So if we're going to be in equities, if we want to accumulate wealth, we need to have equity exposure in order to generate that return, okay? Now, every decade has something. We've shown you this chart before, and 2020 was joined the party with COVID, right? And when I put these slides together, I didn't even want to type 2021 because who knows what's going to come this year. We'll know there'll be something. Will it be a geopolitical issue, a market issue, a war, a new administration? We have no idea what it's going to be, but there'll be something, and that's okay. We're just going to manage around that. So we anticipate a volatility. We anticipate that the markets are going to be choppy. So just don't worry. We've got you. We'll manage through it just like we did last year. Okay? When we think about the market, we like to think of really, there's only two ways you can invest, right? Two sides of the coin. You can be risk on or risk off. And so we have the red bull, right? And that's where you can take risk and try to make money in equities. Or there's the bear, the green side of the coin, the risk off side of the coin. And that's where we look to protect money or follow more asset allocation principles. So when we look at this chart, we see that on the left we have asset allocation, and on the right we have focus investing. So asset allocation is where we use annuities and bonds and asset allocation models, and then the focused investing where we're trying to gain and capture market return on the right side of the coin is individual stocks and the hedge funds. Okay, and so what we really try to do for you is find the right balance, and everyone's different. So for some clients, they want to be 60% risk off and 40% risk on. Other clients want to be 30% risk off and 70% risk on. And so we have portfolios that can accomplish all of that for you, and so we can keep you well balanced. Okay. Now, what happened last year? Well, it's no surprise. The geopolitical and U.S. Frictions were caused by COVID-19. It's really been the driver of the market. We did have an election, and that was an important factor, but really not as important as the recovery from the COVID and the virus itself. When we look at the Federal Reserve and the European monetary banks and the Bank of England, et cetera, there's more. They put a lot of money into the economy. There's more money coming, so the Feds and the monetary banks around the world are very accommodative and will continue to be so. U.S. equities are slightly overvalued as measured by the forward-looking PE ratio and some other metrics that we'll go into. And even though the general market's overvalued, we still find pockets of value within those markets. And we'll see a chart in a few minutes where 60% of the NASDAQ return came from 6 stocks. Okay. Growth expectations are higher coming out of COVID. We started lower, so we're expecting to have higher returns this year in earnings and revenue. And GDP is, consensus estimate is to be about 4%. We continue to have elevated macro uncertainty due to the new administration. Now, again, we don't really care who's in or out of the White House. We have to do our job and manage money regardless. And again, we'll talk about what factors really drive the markets in a few slides. But we don't know what's to come, so there is some uncertainty there. It could be good, it could be bad for the economy and stocks. We don't know yet, but we'll stay tuned to that. Okay. The economic and fundamental recovery continues. Inflation is always a big topic right now with all the federal stimulus that we've been having. So it is expected to pick up a little bit, but with inflation, what can really rail the markets is unexpected inflation. So as long as the market is expecting the inflation, whether it's 2% or 3% or 4% or what have you, it's not gonna go off its rails. But if it's unexpected, that's when it usually shocks the market. And we'll talk more about that in a few minutes. And then lastly, the 10-year bond, the Treasury bond. The yield expanded here at the beginning of the year. The rate of change was exceptionally high, and we'll show you that. And that exceptionally high rate of return or rate of change on the 10-year, okay, is what kind of put a little damper on the growth tech stocks to start 2021 off. Okay. So here's volatility for the quarter. You can see that it was pretty much contained within 1%. We did have a spike here in October, a couple days that were outside of 1. In normal market volatility, we would expect a 1% move up or down on the S&P 500 on any given day. So right now, at 0.65%, we're well within normal volatility ranges. On the long-term view, you can see here that there's that big spike. There's the big blue spike right here in March from COVID. And then you can see that volatility is really kind of calmed down, which is nice. It's hard to sleep when the market's going up and down 10% per day, right? So right now, you've got a band of maybe up or down 1%, and we can live with that volatility. Okay, so what worked in the past? Well, what worked in the past was focused risk assets, okay? Like been talking about, like we'll see, it wasn't buying the broad market, it was buying a subset of the companies that were working. When we stock pick, we can avoid the companies that have bad earnings, right? We can avoid the beach stocks, per se. And so that prevailed. If you buy the index, you're getting everything, good or bad. And so last year, focused risky assets worked. Patient investing worked. Again, when COVID hit, a lot of people panicked. We didn't know what to do. Not us personally, but the world didn't know what to do. And so, it was people got impatient. They wanted something to happen right now. And so a lot of people got out of the market too late and never got back into the market, right? And so proper active tactical management worked very well. We were able to negotiate that very well last year, so we're happy with our decisions and our feedback loop. We would do it again. What detracted from performance was risk-off assets held too long, okay, or not getting back in. And that's what a lot of investors do, is they wait to the very bottom to get out. The pain point is at the maximum point. They get out, and the problem is they never get back in. Okay, so that detracted from return. We started to see rotation from growth to value about August. You'll see in some of our tactical rotation strategies, we started to rotate to more value. You'll see from more large cap to small cap now is participating a little bit better. And again, the rate of change on that 10-year is detracted from the large tech growth companies. Okay. Now we still believe in those large tech growth companies. They're great companies. Their earnings are going to be exceptional. The future is bright for them. They just took a little breather. Okay. The elections came and went, and the market appears to be more focused on the fundamentals and the recovery than it does with the politics. Okay. So that's refreshing. All right, so let's look at some of the big stocks here. Again, there's no new story here. The 20 big stocks, Tesla up 743%. The lowest bunch out of the group here, Google, was only 31%, right? So some really good returns, abnormal and unexpected returns from these large popular names. On the right column here, you can see the expected return. So although Tesla has gone up 743%, the analyst consensus estimate is for it to, at this point going forward, is down 40. So you can see the return expectations in this far column, okay? Now to continue this theme, like we mentioned earlier, 60% of the NASDAQ 100 return came from 6 stocks: Apple, Tesla, Amazon, Microsoft, NVIDIA, and PayPal. Okay, so again, no surprise there that these were a lot of the stay-at-home and recovery stocks, or stocks that did very well during the COVID and the whole COVID recovery process. Okay, so again, concentrated stock picking. We don't just want to buy the index. We want to look for opportunities within the index. Here's a different way to look at the NASDAQ 100. These are the leaders and the laggers. You'll see that 92% of the stocks were up, or 92 stocks were up with 23 down. So great leadership in the NASDAQ last year, and the story we all know that those growth stocks prevailed and technology growth stocks prevailed. Okay, here's an interesting. This is just an interesting fact. So we do a lot of research. What I'm showing you here is a chart of Apple, and it shows the percentage of R&D as a percentage of sales. And so way back here in the 2000s, Apple was spending 8% of its sales on research and development. Well, what you get when you spend a lot of money in research and development is you get new products. And so if you think about Apple's history, the iPad, the iPod, the AirBooks, all the watches, all of the wonderful products we've gotten from Apple was all because of this investment that they put in to R&D back here. Now you see that they really stopped spending on R&D, and down here at 2012, they really bottomed out. Well, what's exciting is look at where we're at now. They're back to almost 7% of their sales being spent on R&D. Now, it's one of two things are going to happen. Apple either has a lot of new products that are going to come out that we just don't know about, which is exciting and will really continue to grow the company, or they could have spent a lot of money and they won't have any new products, and that'll be a problem. But I think we'll bet on Apple that all of this money being spent on R&D means that they're probably working on some really cool new technologies. So we'll wait and see, but that was just some research that we thought we'd share with you. Apple's one, favorite of everybody, and it's a great name. And the news always wants to talk about is Apple overvalued or not. So we just, as we were doing some research, thought that this chart was fun to share with you. So, okay, so back to the past. You can see here's the countries. So Denmark was the best performing country last year at 42%. And Brazil was at the bottom at 20%. So it just gives you an idea. Even though we had COVID around the world, we do have pretty good participation in the global markets with their equity recovery, which is an amazing story, because when the world was melting down last year and it was a global disaster, and most people thought the world was coming to an end, the world ended up pretty good at the end of 2020. Okay, what's going to happen in the future? Well, as you've heard me say before, there's only a few things that affect equity markets: inflation, interest rates, corporate earnings, and the Fed. And we're going to go through each one of those. Okay. So when we look at inflation, inflation. Why shouldn't we have some more inflation? We have a lot of fiscal stimulus. We have a lot of wealth. GDP is going to be 4 to 6%. And as the vaccine gets disseminated and the economy recovers, we're going to have more spending, which means more dollars are chasing more products, which means that we have an inflationary pressure opportunity. So what we see on this chart is the white line is the 5-year break-even number from inflation-proof bonds, TIPS, and the blue line is the PCE price index. And so you'll see that the expectation of inflation in the white line is ahead of the actual inflation. Here we see the gap between the 10-year Treasury inflation-proof security and the 10-year securities. That gap is widening. So again, an indication of some inflation that might be coming. The University of Michigan study, which is the white line, shows that the survey is about 2.7% for the next 5 years. The Fed target is the red line, and their mandate is 2%. And the orange line is what inflation currently is doing. So again, it's not the number, it's the expectation. So we're expecting a little more inflation. And as long as it's below 4%, equity markets can absorb that very well, because companies can pass on pricing to their consumer. Okay, so we do expect a little bit more, but we don't at this time have any evidence or data that suggests that we should have runaway inflation yet. Okay, and if we do, we have our metals portfolio we'll allocate to, and we can take advantage of that. On the bottom of the chart, you see a blue line. This is unemployment. So unemployment spiked, obviously, and it's come back down. Now, as more people get back to work, right, they'll have more money in their pocket, they'll spend more, and therefore, if you see the unemployment rate start to come up, that's also an indication that we could see some inflation. Turning to interest rates, you'll see that we have a positive rate, positive slope on the yield curve. There we go. I can't spit that out. Yield curve, and that means that there's not a priced-in recession. So the recovery continues. And we'll see here that the 10-year is now at a little bit over 1%, and the 30-year is at a whopping 1.8. Okay, so rates are still low, but we have a positive yield curve, and we think rates will probably come up a little bit on the bonds, but not necessarily on the Fed funds rate. Okay, so this is the chart that shows the rise of the interest rate, 10-year interest rate, and you'll see that back here, beginning of the year, we see this big spike. This is the rate of change I was talking about. This is a massive acceleration. And this is what had put a pause on the large cap growth tech stocks. Now, as that rate of change comes down and levels off, we'll probably see those companies start to prevail again. Okay, so here when we look at the outlook of rates, we have the Fed model, which is called the Taylor model. And it's a model that predicts where rates should be to have an economy that's not detracting or growing, and that's 1.4%, rounding it off. That's the blue line. Well, where we're at 0.25, and the distance between 0.25 and the Taylor estimate of 1.3 or 1.4 is big. So rates can really come up. Now, if we look at the evidence from the dot plots, which is the Fed governors voting, you can see that the vote is to keep rates very low until about 2023. And then they get up to about 2.5%. So again, we're expecting lower rates for longer. The last curve here we'll see is the difference between the 3-month bond and the 10-month bond. You'll see that spread is rising, and so again, another indication that those bond rates are coming up a little bit. With that, what are we going to do? You'll see us to start to decrease our bond exposure a little bit. Okay, turning to earnings, no doubt here, this is an overvalued market. The forward PE ratio of the market, which is the PE ratio is a crude measure of value, is at 27 compared to its 5-year average of around 18.5. So there's definitely at the index level it's overvalued, but as we saw, there's still some room to go in the leaders within the S&P 500. So what do we do about that? We continue to focus, invest, and tilt towards a selective group of equities. When we look at the other valuation models, what's amazing is that they're all in their 100th percentile over the last 10 years, right? So all these are, you don't have to really worry about what they are and what they mean, but these are different measures of value, and they're saying, they're all telling the same story, okay? The only two that aren't are the enterprise value to sales and enterprise value to trailing 12-month EBITDA, and because they're trailing numbers, and we look back through COVID in 2020, that story is true, right? We know that those sales and earnings were down. So on the right, you can see what we expect going forward for growth in the S&P 500. We're expecting about an 8% growth in revenue. And over here under the green line, you can see earnings are going to be expected to be right around 22%, which is way above average. And again, when you're starting at a low point coming up, you're going to have a large rate of growth on those earnings. So how do we get to that number? Well, we look at the current earnings, the current trailing 12-month earnings of 125, and here on the green bar, and the best expected earnings 12 months from now, based on analyst consensus, is about 165. So that change is about 30%. So depending on the estimates and the analyst, somewhere between 20 and 30% growth on earnings. Now, what does that equate to? What does that mean? Well, it means that if we look at earnings from where we're at and where we might be 12 months from now, that equals a return of about 8% on the S&P 500. Okay, so we're currently at 37.68. The best target price is 40.70, so that change is about 8% over the next 12 months at the S&P 500. Another way to look at it, this is a complicated screen, so I apologize. This is a spreadsheet that I write to look at the VIX, the measurement of volatility. And what it shows me is that based on the current volatility of the S&P 500, we expect a move of about 10% over the next year. Now, the problem with that is we don't know if that's up or down, right? But the movement should be about 10%. If we base the movement on the VIX, the measurement of volatility, okay, we get the bottom number here at 22%. So when we put them all together, for asset allocation, we're looking for about 3 to 6% returns with 9% risk. And on the focus investing, we're looking at a return somewhere between 5 and 12 with about 15% risk. Okay, so that's just your forward-looking expectations of both that risk-on and risk-off strategy. Now, when we look at our portfolios, the focus growth portfolio, based on a fundamental bottom-up basis, has about 11% left in it over the next 12 months compared to the benchmark at 8. But you'll notice we're taking a little less risk at beta of a 0.95. So a really nice risk-adjusted opportunity. On the dividend portfolio, we see the same thing. We see an expected return of 9 compared to the benchmark at 5.5, with a higher dividend yield and a beta of less than 1. Now, our portfolio is lagging just a little bit in the value space, and you can see that here between what's expected. Our return has almost doubled the expected return because some of these names, which are great companies, just haven't recovered yet. Coca-Cola has been down big for the year, but as the economy recovers, Coke will recover. So some of these names we just have to be patient on, but they're solid companies, they're great companies, and we are very excited about that portfolio. Okay, on U.S. equities in general, we're pretty bullish on the market right now. International, we think are great opportunities as well. Same with emerging markets, so we're bullish on global equities. The U.S. fixed income, we're really neutral to bearish on. And real estate, as you're going to see in a second, it's been down, but it's really has some good returns that are available in the future. So we're neutral, and we'll become maybe bullish on that as that story unfolds. So here, looking at those sectors, you can see that utilities has got an expected return of about 13.78, and then commodity communications, and then real estate. Okay. And then materials down here at 3.46. So again, across the board, the sectors look positive. Again, you just don't want to buy every sector. If you can concentrate on the sectors that are looking undervalued and to prevail, that might lead to better returns. This is a chart showing how the sectors rotate. This blue quadrant is improving. The right green quadrant is leading. The yellow bottom right quadrant is weakening, and the left red is lagging. And so, of course, you want to be in the improving or leading, and you can see that energy and financials have really come on over the last 10 weeks, okay? And the rest of the sectors are kind of really just rotating right around the index. So this is how we kind of look for sector breakouts and where the puck might be going, as Wayne Gretzky used to say, or continues to say. And so we spend a lot of time looking at that sector rotation. Okay, so going forward, we expect, lower long-term returns. Inflation's around 2.5%. We do expect the 10-year to come up a little bit, which will be welcome for people that have cash and are looking for fixed and safe places to put money. We still believe that the evidence shows active and tactical management will prevail. Asset allocation is starting the year off very well and will continue as we get broad participation in the recovery economy. Volatility is currently contained, and if it breaks out, we just won't know. It'll be a black swan event, but there's nothing right now that we can point to that's expected volatility. The unexpected volatility is unknown at this point. Risk management, again, may become popular again as we get further into the recovery. Corporate earnings growth lower, but really recovering well this year, and we're really watching those margins and growth. So, all in all, thank you. We'll end with this quote from Peter Lynch. It says, it was Peter Lynch, one of the world's best investors of the 20th century, that said it best: far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. So with that, we stay the course. We'll keep you well balanced. We're happy with how the portfolios are working. If you need to make changes and change your risk on or risk off temperament, just give our office a call and we can make those adjustments for you. And again, thank you so much for being with us, and we look forward to a great 2021. Thank you so much.